So, how does a typical recession progress? What's the sequence of events that leads to an economic downturn and ultimately a full-blown recession? Every recession is different. However, there is a common sequence if you look through, as we're going to, centuries worth of economic data. If you can understand that typical style, then you can see how each recession differs. Particularly, how is the coronavirus recession different and what does that mean for your business? This is a slide that you've probably seen. I'm not going to go through it in as much detail as we have previously, but this is the simple ups and downs, boom and bust of an economic cycle. Importantly, this recognizes the emotional impact that goes on through the cycle, from the excitement, the thrill, the euphoria of a boom, through to the anxiety, the denial, the fear that maybe has been going on for you, certainly has been going on for the wider economy over the last few months. And that's the respond phase of a recession. The first few months when things have changed and you need to rejig your business. You need to rejig your business at that point for the new normal of being in a recession. But don't get caught there, because you also need to start asking yourself, well, what's the new normal on the other side of this recession? Once you've got through that respond phase, that's where you head into the plan phase. The plan phase is about, okay, well, what do I need to do to transform my business for that future, for that new normal? You don't necessarily execute those plans until you get to the bottom of the cycle. And you may notice a bit of a disconnect. I'm sitting there telling you to plan for the future, to be somewhat optimistic, while at the same time acknowledging that in the wider economy, the emotions are going to be of desperation, of panic, of despondency. It's important for you as a business owner and a business leader not to resist or to ignore your emotions. Indeed, if you feel those things, to reflect on those, to identify them, acknowledge them. However, don't get caught up in those. You have, and it is a burden at times, a responsibility to your team, to your family, to yourself to keep your business going and growing. And that means using that optimism that you naturally have as an entrepreneur, as a business owner, to plan for the future, to keep your powder dry and ready to execute when we hit that bottom point, where there's the point of maximum opportunity, and to benefit the most from the upswing, maximum profit, maximum brand awareness, market share that you've created going through the recession. And a lot of people want the time frames. When will the coronavirus recession end? The respond phase is normally about 3 months. So for many of us, we're starting to come out of that respond phase now. We are heading into the planning phase. The length of the plan phase depends on the shape of the recession. We're going to talk about that a little bit later when we look at how the coronavirus recession is different. You may recall that I'm forecasting, along with many others, an L-shaped recession, one that lasts longer, which means that that execution point is not going to be in 3 or 6 months' time. It's likely to be the second half of 2021 at the earliest. Again, right at the end of this presentation, we're going to talk about what all of this means for your business. So that's the broad economic cycle, but what is it that actually triggers a recession? How do they start? How do they progress? How do we go from something through the butterfly effect into a full-blown recession that affects the wider economy? So what are the dominoes in this progression of a typical recession? Well, it normally starts with a sector, an industry that has some issues, has some challenges, that causes the whole thing, sets off the trigger. That flows through to the banks, the finance, the liquidity. That has an impact on suppliers to that sector and working with those banks. That then flows into the tertiary network. We get these multiplier effects out into the wider economy. Before we know it, we're all in this together. So sector X falls over, and before we know it, the whole row of dominoes has come tumbling down. It's an interesting phenomenon around recessions is that we know they happen fairly frequently. Once every 7 to 10 years is the length of those economic cycles. And yet, despite knowing that they're going to happen, we do a terrible job of actually being able to forecast when and exactly why. And the reason is that sector X, that X for the unknown. If you think about an analogy, if I'm driving a really fast car, incredibly fast down the motorway, doing 200 miles an hour, I have the pedal to the metal, and I'm going as fast as I can, it's fair to say that I'm probably going to crash at some point, perhaps even fairly soon. You know that there's a crash coming, but you don't necessarily know exactly what's going to cause the crash. Am I going to lose focus for a moment and smash into a guardrail? Am I going to pass a truck and get sucked under? Is a duck going to come flying in my open window, or a goose come flying through my windscreen? Am I going to blow a tire? Is my transmission going to dump? I'm driving recklessly. An accident is imminent, but the exact cause of the accident is unpredictable. And it's the same for an economy in boom times. It is overheated. It's moving too fast. There's some inefficiencies that have been built into the system by the bubble that is blowing up. We know that at some point that's going to burst, but exactly what causes it is unpredictable. And that is why, even though we know recessions are coming, economists, the dismal scientists that they are, still do a terrible job of actually predicting the why and the specific timing of a recession. And even me, I pat myself on the back for having prepared my clients and my viewers with recession videos from late 2018 onwards. But of course, I couldn't have foreseen that this recession would be caused by a global pandemic. I just knew that we were due, that something would trigger off sector X. So, what are some of the examples? And again, when I talk about history doesn't repeat, but it rhymes, I'm not pulling some of this information out of my bum. I'm not just talking about my experience through the Great Recession. As a student of economics, as a student of history, and as a student of business, going through and looking at causes of recessions going back centuries to see what they have in common and where they have their differences. Some information that came out of the UK forecasts this week is that the recession there could be the worst since 1706. So in terms of data, we've got a lot going back more than 300 years. So what was sector X in 1706? Well, that was agriculture. We had through the 1700s, 1703 to 1709, we had a solar minimum. We had some of the coldest winters of the modern era, and that led to multiple consecutive crop failures. So in the UK and across Europe, agriculture set off the recession of the 1700s, 1706 to 1709. 1789 was something completely different. It was actually copper debasement in the US. Coins, which were the main form of currency, were made out of copper. Different states started to put different amounts of copper. The volume of copper available to the market started to go up, so the value of copper started to decrease, and therefore people started to fear the value of coins, particularly those from others. You can kind of start to get a feel as you go through these that predicting exactly which sector is going to trigger an inflated economy to explode is difficult to do when it's something as simple or unpredictable as the amount of copper in coins in a different state to yours. 1857, which was the first global recession, that was really triggered by railroads, the inflation that had gone on, the over-speculation railroads in the US, and that tripped, that fell, that caused collapses in Ohio, in New York, and then flowed through to the rest of the developed world, such as it was in 1857. 1893, another big global depression. That was triggered by real estate speculation. As far afield as Argentina as Australia, these things were starting to have an impact on American investors, speculators, and in the UK. 1929 was a little bit different in that the causes are much debated. It's generally appreciated that what happened there was indeed an overheated stock market, that was investors across a range of sectors that were just getting too exuberant, too optimistic. And so when that crashed, it crashed hard. And then you also had much faster spread of news in 1929 compared to, say, 1857 or 1706. And that caused the panic to be deeper and to spread much faster, caused deflation, set off what we know as the Great Depression. Other sectors within perhaps living memory, the 1970s, we had a couple of recessions, a double dip recession through into the 1980s. That was largely oil. 1990 was real estate and oil. The 2000 was the dot-com bust, impacted in part by September 11. 2008 was a very, very different recession in that it was actually bank-led. So normally, as you see, a sector goes under, a sector has challenges, and that has an immediate flow-on effect to the banks. 2008 recession, the Great Recession, GFC, was different because it was actually the banks that were the sector. We skipped that first domino entirely. It was the banks that fell over. 2020, of course, what's the cause? It's the coronavirus pandemic. But again, it's not that a single one of those had a wide-reaching impact on the economy on its own. The economy in all of those instances was already fragile, was already at the peak of its boom, was already that car driving too fast down the freeway when something happened that set off the accident that they weren't able to control. So recessions are caused by sector X, whatever that might be. The next domino to fall then is the banks. And by banks, I really mean finance, liquidity, availability of cash in general. So that first hits those banks that are exposed to that sector. But people who, especially since the 20th century, making money by speculating, by looking at what the future holds, they start to see that we're having an issue in banks in terms of wider liquidity in the economy. So they start to forecast that we're heading for a downturn or we're heading for a recession. Stock markets, being that lead indicator, start to drop in advance of that actual wider recession. Again, this is a typical recession progression. The speculators, the investors can see that, okay, we're having issues around oil. That's probably going to flow into the wider economy. Therefore, growth prospects for the wider economy are down. Therefore, I'm going to sell, or I'm only going to pay a lower amount for the shares, for investments in the wider economy. And that's why typically the share market is about a 6 month, somewhere between 3 and 12, about a 6 month lead indicator of the wider economy, because people who are investing today are speculating on the future. When they have some consensus, it's normally because there's enough data that things are happening, that sector X has collapsed, that banks are starting to struggle. And there's also a little bit of a self-fulfilling prophecy in that if 90% of people think a recession is coming and are behaving accordingly, they're probably going to cause a recession, even if it may have been avoided. So sector X collapses. The banks at first that are exposed to that sector start to have liquidity issues. Other banks, because banks are all interconnected, start to have liquidity issues. We also start to see a fallout in the general economy. Any suppliers that are going into sector X. So if you think about a mining crash, mining sector looks after a lot of businesses over and above the actual mining that gets done. So if commodity prices collapse, if oil prices collapse, it's not just those who are mining those commodities that are impacted, it's all of the suppliers that are going into that. It's all the companies that need that bank finance that is now suddenly not available because banks are being cautious or have collapsed. And there's also a geographic element to that suppliers, that flow-on effect into the dominoes, in that mining is another good example where you may have a whole geographic area that is highly dependent on a mine or a series of mines on commodity prices. And so as that first domino falls, they fall fairly shortly thereafter. And we start to then get the wider effect. It's certainly possible that in some economic downturns, they stay as sector specific. In other words, those first 3 dominoes fall, but they don't make the connection to the fourth. Now, mining might have a downturn, a specific commodity might go under, some banks are exposed, there are some issues, definitely some suppliers or some geographic regions are impacted, but it doesn't have that wider effect. To really trigger a recession, we need that fourth domino to fall, and that's now the tertiary network. So this is now the wider impact of just that sector. So the downturn starts to spread into other sectors, other communities, other asset classes. Commodities goes down, that impacts stocks, it starts to impact stocks in other sectors, and that starts to have an impact on real estate, on gold, whatever it might be. We start to get the tertiary impact of sector X having a downturn. Once that wider downturn starts to spread, spending across the economy slows, or in a worst case scenario, stops. And it stops across multiple industries. It's not just that miners aren't investing in new mines, it's that people aren't now investing in new banks, people aren't opening their businesses. And what typically happens in a recession is that that's top down. It tends to be the largest companies that slow their spending first. which then means the mid-tier companies who are often supplying into those large companies, they start to experience a downturn, and it flows down through them into their clients, their suppliers, and the entire supply chain through that tertiary network starts to have a crunch, starts to have a slowdown. At this point, we could be having either or both of a demand side or a supply side issue. Demand side, which is the most common in a recession, is when that spending slows. People are spending less, they're demanding less because they're buying less, then there's less money circulating in the economy. The supply side issue happens when businesses shut down or slow down to the point where they can't actually supply the demand that still does exist. This is much rarer, and it tends to trigger a longer recession because demand can pick up, and if there's still goods to buy, then the economy can pick up faster. If demand picks up, but there isn't that supply that takes time to actually build that up again, you get a longer lag, you get a longer recession. Now, once a recession hits that tertiary network, that's when government intervention tends to start. Now, government intervention is largely a creation of the 20th century, and specifically the late 20th century. The general consensus is that the Great Depression was deepened and lengthened by a lack of government intervention. And certainly prior to the 1920s, there was not that central infrastructure to record the data, to see these things happening in real time, and to actually have the money at a government level to spend on stimulus packages and so on. What we see now, and we've certainly seen through the coronavirus recession, is governments much more willing to jump in at this level. The reason why governments jump in as soon as that tertiary network starts to get exposed is that they want to cut off, ideally, or at the very least restrict the negative multiplier effects, the way a recession starts to spiral into the wider economy. One of the impacts of government intervention is that it creates zombie businesses, potentially even whole zombie sectors. So these are businesses that are propped up by the government intervention that are the walking dead. As soon as that intervention stops, they're going to be gone, they're dead. In many cases, they don't even know it yet. The negative multiplier effects are once that tertiary network starts to go into a recession and the fallout of that starts to flow through. So this is the point at which unemployment generally starts to increase. Again, unemployment being a lag indicator, especially when it's reported. Sector X may have collapsed several months ago. It's only now that the tertiary network is having an effect that we start to see unemployment. There's that great line that's attributed variously to Harry Truman, President Ronald Reagan, that a recession is when your neighbor loses his job, a depression is when you lose yours. The unemployment starts to have a real effect when it becomes official. It's amazing how many people will panic this week because of those official recession unemployment numbers that have come out. When they heard that people were probably losing their jobs, they were keeping an eye on things, but it was only once they saw 14.7% unemployment, they went, oh, this is real, and I'm going to change my behavior accordingly. So this is how these effects multiply. Unemployment increases, it becomes official, people start to respond to unemployment numbers, and of course, for those who are relevant to being unemployed, having a family member unemployed. Business confidence starts to decrease, consumer confidence starts to decrease. Consumer confidence is often one of the slowest things to happen in a recession because people assume somewhat optimistically that they'll be fine, that these things are happening off and away from them, that won't impact them. It's only once they start to see these negative multiplier effects all around them in the economy that they start to get worried, they start to get cautious. Confidence goes down, there's less spending, less optimism. That creates some of that demand side recession element and creates a downward spiral. One of the impacts, interestingly enough, of those multiplier effects of a recession is that fewer people die. So in a typical recession, death rates go down. Now, overall, if you look at the overall history of an economy, growth helps extend longevity. However, specifically during a recession, the actual rate of death goes down. And this is a few different factors, things like fewer people are driving, so there's less car accidents. There's far fewer workplace deaths if there's far fewer people actually working. Other things like alcohol, drug use, some of these kind of behaviors can dwindle. People buy fewer drugs when they have less money, therefore fewer drug overdoses. And so one of the perverse and unexpected things of a recession is that it can actually help extend life projections, longevity. It's certainly not universal. There are some sectors, some indicators that increase. Suicide is one of the most obvious and perhaps the most unfortunate impact of a recession is the volume of suicides that increase. During the coronavirus recession here in Australia, because we've largely been spared, at time of recording we have fewer than 100 coronavirus deaths. There are estimates that the economic impact will lead to between 750 and 1,500 extra suicides. So for this specific recession, more people in Australia are expected to die of suicide from the economic fallout than they will from the actual coronavirus that caused the pandemic. However, increase in suicides is typically offset by decreases in a lot of other areas, and it can be quite interesting. I read a great article, some research out of the UK that suggested the lockdown of the coronavirus recession could actually make a permanent dent in HIV. The spread of HIV, which is already slowing, but people are most contagious with HIV in the month after they contract it. So having a lockdown where fewer people are out and about, there's fewer new sexual partners being created. They think this could actually have a permanent dent on the spread of HIV, which, while it's not the death sentence it used to be, is still a disease that is somewhat preventable, is treatable, but is certainly not. There's no vaccine for it. It can still kill people, and so that would be an incredibly positive outcome of a recession. So not all of the multiplier effects are negative. One of the scariest from a broader macroeconomic perspective of the negative multiplier effects is deflation. So we are mostly familiar with inflation, where the costs of goods rise over time in your business. You put your prices up, not necessarily every year, although I encourage many of my clients to ask themselves that question at least annually. Deflation is when things start to go backwards. You can now charge less for your services, which has a massive impact often on your profit margins, especially if your team are on the same salaries, if a lot of your other fixed costs haven't changed. Of course, the wider impact of that deflation is that it can spiral down. If you're having to charge less for your product or services, you're going to have a conversation with all of your suppliers, with your landlord, and with your team about possibly paying them less. And that's how deflation can spread in the economy. The very largest risk of deflation is what impact that has on demand side spending. Inflation, the reason why central banks and governments like inflation to sit at that 2 to 3% level, which is a guide in most developed countries, is that inflation devalues cash, devalues savings. If something is going to cost you $100 today, it's going to cost you $105 next year, you're more likely to buy it today, which means you're going to spend money today. Spending money stimulates the economy. Everything you spend goes into somebody else's paycheck. In a deflationary environment, that situation is reversed. Are you going to pay $100 for something today that's going to be $95 next year? Possibly not, especially if it's a discretionary purchase. And so deflation means people stop spending. The value of cash starts to increase, even if you're not getting a decent return on your savings account, and interest rates, of course, are at an all-time low. The fact that your dollar is worth more next year means that you're better off saving it, not spending it. And if you're not spending it, then you're not stimulating the economy, and the deflationary impact kicks in. One of the reasons why government stimulus packages are designed to try and flood the economy with cash, whether that's quantitative easing, whether that's stimulus packages, whether that's lowering interest rates so that people have more money to spend. So they want you spending, they want that inflation staying steady or continuing to grow. So those are the negative multiplier effects. At this point, what started as a fallout, a downturn in a specific sector is now community-wide. To coin a phrase that you've probably seen in a few emails, we're all in this together, and that recession is no longer a sector-specific downturn, it is a wider recession. And so that is how a typical recession starts and progresses. Sector that flows through to the banks, flows through to their suppliers, and then triggers it, starts to have a tertiary impact on other networks, other sectors, other geographies, that then leads to negative multiplier effects through the impact of demand, confidence, of unemployment, until finally we find ourselves in a recession and we're all in it together. How does a recession end? Well, typically recessions start to end when sector X gets their stuff together. So they bottom out. There's a broad principle, first in, first out. Those sectors that start the recession are often the first out of the recession, and it flows through. It also requires wider inefficiencies in the economy to be cleansed. So remember, a recession doesn't occur just because one sector got out of control. A recession occurs because the whole economy is going too fast, has built in too many inefficiencies. And those inefficiencies need to be washed out before the whole economy can go into a recovery phase. As I want to say, combining a couple of different Warren Buffett quotes, when the economy is going up, a rising tide lifts all boats. It's only when the tide goes out that we see who's been swimming with no clothes on. And that's what we need to see to truly get through a recession. Those zombie businesses that maybe were being propped up by the government or being propped up by over-optimism in the general market finally get their heads chopped off. And the broader economy benefits from that overall. That's why it was such a problem for the Australian economy that we haven't had a recession in 30 years. Even though in the short term, that is a good thing, fewer people losing their jobs, fewer businesses closing down. The reality is it means we haven't had some of those efficiencies forced upon us that we need. That's part of the reason why, to take a rough, crude indicator, but the ASX, the Australian stock market, has not grown over the last decade at nearly the rate of the American indices, because we didn't have the severe recession that the Great Recession caused, the double dip recession in the United States. And as a result, we didn't fix some of those things that need fixing. Australia may in some ways be the lucky country again in the coronavirus recession. That could set us up to continue to be the unlucky country in actually lopping the heads of those sectors, businesses that need it. So that's how a typical recession progresses. We jump into the next session, we're going to have a look at the coronavirus recession. How does that differ?